Hello, hello. Welcome, everybody. Give it a couple seconds for the attendees to release, and we'll get started. There we go. All right. Welcome, everybody. Thank you for joining me for Clarus and Gust's R+D Tax Credits for Startups. This is maybe I would say it was previously not well known, but increasingly well known in the startup space. A really cool possibility for some additional income for an innovation-based startup. We are not experts on this at Gust, so we brought in some people that are. So every year it's Q1. If you're a Gust launch customer, you are probably receiving Delaware franchise tax emails. You're receiving, corporate tax notices and all sorts of stuff like that. It is tax season and will be until sometime in April. And while a lot of times it's a pain, it's a lot of clerical compliance work. You have to, shuffle things around and work with your accountant. There is some cool upside to this, specifically if you apply or if you are, I don't know what the word would be, qualify for the R+D tax credit. So I'm joined by Haley Davidson and John Burku, who are experts in this space. We work with them every year. I think this might be the third or fourth year that we've done this kind of programming. We always have a good turnout, great questions, and we can help a lot of startups maximize their runway by actually getting some money back in the form of tax credits. So without further ado, I'm going to pass this over to John, who's got a presentation for us. I'll do some emceeing, and Haley's going to help answer specific questions. So please use the Q&A functionality to ask questions. I've opened up the chat. If you want to say where you're from, what your startup's name is, feel free. Do not pitch it. Nobody's going to, respond to pitches in here, but, get a little cross collaboration, let people know what they're up to. It's pretty cool. And we'll have time for questions at the end and probably a break in between if we get some relevant ones. And we will have links to share with you if this stuff appeals and you feel like you are a good position for this. At the end of the event and in the follow-up materials, we will send you all the right places to go and resources. Additionally, yes, we are recording this. Yes, we will share the recording out also with that. And I believe we'll be able to get a copy of the slides too to go with the recording. Awesome. All right, take it away, John.
Perfect. Awesome. Well, thank you very much for the introduction. My name is John Burku. I work for Clarus on our expert team on the R+D tax credit. My background, I come from KPMG, and before that I was at Clifton Larson Allen, both working on the credit or working on the credit at both of those companies. So everything from super small to super large companies I've worked on. So feel free to ask any questions that you have throughout the presentation, and I'll stop somewhere in the middle just to give some time for questions, and then once we get this answered, we'll go through the second half. But hopefully some meaningful content. We work at Clarus with a lot of startups. That's really what our company was founded on, was working on the R+D tax credit for startup companies to help bring some investment back to the company and save on the tax side, so you guys can do what you do best and innovate and create new things. So with that, we'll go ahead and get started on the first half and see what questions you have. So that's just our introduction there. We went through that. In the presentation today, we'll touch on what is the R+D tax credit? Does your company qualify for the credit? Does your work qualify, and what type of work qualifies? How much can you claim on the monetary side? And then also, what's our process look like, and why our company? So I guess before we get into the presentation, and we'll get into this later, but our company, just to give some background for people that haven't heard of us before, our company created a software to facilitate the R+D tax credit to make that easier. Traditionally, the process was very manual. You would go to a firm that had Excel and specialty in the R+D tax credit to claim it. They would document it, provide reports, and it was a pretty expensive process. Like I said earlier, our goal is to help startups out and create a way to make that easier, and an easier way to capture that investment back and bring it back to you guys without having to pay out such a significant amount. So for those of you who haven't heard of what the Federal Research and Development Tax Credit is, it was formed in the early 80s, and basically it was formed in order to encourage domestic investment in R+D. At that time, there was a lot of companies that were leaving the U.S., and innovation was being forced overseas. And so the U.S. government knows it's expensive to innovate, and so they wanted to keep those jobs and that know-how in the U.S. And so this was their solution to doing that, was to create this tax benefit. And though it's evolved over the years, it's been in a positive way. So before, and we'll get into this here shortly, but it was primarily in the beginning for much larger companies to take advantage of, is it was only an income-based credit. But they realized that that really wasn't the best way to capture a lot of the startups and smaller companies that maybe aren't in an income position yet or are pre-revenue. So they expanded that. But this is kind of their solution to keeping that know-how and that innovation in the U.S. and returning some benefit on your investment. So prior to 2015, which the PATH Act is passed in 2015 in December, each couple of years the Congress had to permanently, or had to extend rather, the credit. So there was a lot of latency in determining whether it was going to be extended this go round, or what the kind of political environment was for extending the credit. So finally, as a result of the PATH Act, it was made permanent. And so as a result of that, there's no more extension on the R&D tax credit. Startups, as a result of the PATH Act, can offset the payroll tax and AMT with this credit. And the credit acts as a dollar-for-dollar reduction of your tax liability on the income side. And then we'll get into how you can use it to offset some of your payroll tax as well here in a little bit. But it also laid out on the instruction side or regulation side, it clarified the definition of qualified research and software development activities. It further defined what qualifies in that space, and I think positively affected that. So just to reiterate kind of what I just went through, created new opportunities for early stage businesses. So prior to 2015, it was only an income credit. So they realized that wasn't a great way to continue to incentivize innovation. And so to do that, they expanded that to the payroll tax credit. It's more permanent now, and it generally results in between a 7 to 10% benefit on your qualified investment. And there's a calculation behind that on how we get to that. But that's usually what it returns, is between 7 and 10%. And it can be claimed every year. So it's not something you just claim once and that's it. So you can claim it every year, and it applies to new or improved products, processes, techniques, formulas, inventions, software. So it applies to a pretty broad range of projects that you might be working on. And so the bottom here just talks about this. This is an access, or provides access to a new form of non-dilutive capital that had not existed before. And so that's what makes this an attractive and exciting credit for newer companies. So in order to qualify as a startup, you meet two criteria, and the IRS has this defined. So the first category is you have to have less than 5 million in gross receipts, and this says tax year 2021, but really you have to have less than 5 million in gross receipts in the tax year that we're calculating the credit in. And then prior to that, you have to have zero gross receipts 5 years prior to that. So in this example, you have to have less than 5 million in gross receipts in 21, and then prior to that, just less than 5 million, or have zero gross receipts rather, prior to 2017. When you qualify under the payroll, you can claim that 5 times, and once you outgrow that 5 times, or you outgrow the income limitation there on the gross receipt side, you can use it against your income tax liability, and it's a dollar-for-dollar reduction of your income tax liability. Any questions on that before we move on? Or have we gotten any questions so far?
Yeah, we have two, a little general, but I think we can hit them. The first from Gleason is, where is the transcription? Oh, sorry, that is a a Zoom question. I actually do not know if we have transcription enabled for the Zoom thing, but I will take a look. And William asks a very common question: what if you have international staff on payroll? Does that unqualify you?
Yeah, so we can claim, that's a good question, one we get a lot. So if you have international folks on the payroll, we can claim their time for the time that they spent in the US, but the credit is designed to incentivize activity and development inside the US. So we can claim, as long as they're receiving a W-2, we can claim the time that they spent in the US, but international folks and any international contracting expenses as well, we can't claim unless the folks are here in the U.S.
Nice and clear. Cool. Oh, here we go. And of course, a question about contractors that always comes up: 1099 employees.
Yeah, absolutely. So contract employees we can claim. So there's three components, and we'll get into this here shortly. But contract employees we can pick up. They're viewed as an extension of your company, and so we can pick them up at a 65% rate. So the haircut just is a statutory reduction to eliminate the overhead or the markup rather in their rates. So that's why. But yes, we can for sure pick that up, and we'll cover that here shortly.
Awesome. And I think you're going to cover this too, but Chris Nicholas does ask, while we go through the 4-part test, what kind of SBIR grants or federal grants do to that financial risk side. But let's jump into it, and we can get to that if we don't cover it specifically, but I feel like you will.
Perfect. Sounds great. Well, to jump into the 4-part test, those are some good questions to get started here. So there are the 4-part test is what governs the R&D tax credit. It's straight out of Section 41. 2 are relatively easy to meet, and then the other 2 kind of define where the R&D is and set that activity apart. And so the first one that's on here is there has to be a permitted purpose. And the meaning of that is there has to be a new or improved product, process, software, formula, technique with increased function, performance, reliability, or quality. So here the key there is products or processes. So if you're manufacturing something or making something, there's also on the process side, if you're trying to do it better, quicker, faster, improve speeds and feeds, things like that. On the software side, if you're improving upon a product that you already have by adding new functionality, continuing to innovate on that, that it's not just the original product that would qualify, it's the improvement to it as well. So the second category here is there has to be, the activity has to be technological in nature. I'm going a little out of order because the 2 in the middle are really where the R&D are, but the activity has to be technological in nature. So this just means the activity has to rely on the principles of a hard science. So here we're looking at physical sciences, biological sciences, engineering, computer science, food science if you're in more of a food atmosphere. But yeah, so there's the hard sciences are really what it's based on, and this just rules out any social sciences. So we get a lot of questions around behavioral platforms that are being created, or company transition, or things like that, where you're creating, trying to help the way people think, or designing a product to help the way people think and make decisions, but that's more on the social side and wouldn't qualify. The third point here is there has to be an elimination of uncertainty in regards to the capability, the methodology, or the design. And so it doesn't have to be all 3, but just has to be one. And then you have to be working to resolve those uncertainties through a process of experimentation. And that just means you're testing one or more alternatives to try and achieve your final result. And there's several ways to do that. You can do that through trial and error and testing your hypotheses through iterative process in software. there's a number of different ways that our software clients go through, and things might not work. It's the first time they do it, so they go back through, um, and that's really what the IRS wants to see. So the whole goal of this is for the IRS to see an iterative mindset where you did not know how to get from A to B without some experimentation and having some uncertainty in that process. So that's more on the qualitative side. On the quantitative side, we measure that activity financially through three different buckets. The first of which is the wage category. So we're looking at your company's employees that are issued a W-2. We look at box one amount. There's three different areas where we include folks. So the first is direct supervision. Then there's direct support of the activity. So direct support and supervision. Then there's the direct performers that are actually doing the R&D. So kind of three different categories there of folks you can include. On the contracting side, like I mentioned, we pick those contractors up at 65%, and they're viewed as an extension of your business. So they have to be in the U.S. They have to be working on R&D initiatives in order to qualify, similar to your employees. And then on the supply side, we're looking at non-depreciable, tangible personal property, which is used in the development activities. So you can say it's generally consumed or destroyed throughout the R&D process. And what that means is, if you're a software company designing, some sort of software, we're not looking at the computers that it's designed on. We're looking at the databases or things like that, softwares that you use in order to develop your product. So we're looking at AWS, Azure, things like that, any other softwares that you have to purchase in order to build your final product. And in a manufacturing setting, we're not looking at the machine that's running the product through it. We're looking at the product that's running through it, where there's an uncertainty in whether that is going to be successful or not. So it's the actual supply that's consumed or destroyed, not the capital equipment. And once we combine all those categories together, like I said, usually it provides about a 10% benefit, depending on the method that's used, but 10% of your QREs or your qualified research expenses. So our process, we go through, we were very hands-on with our clients, so we like to be very interactive. So first step is the kickoff call, just getting to know you, your business, what types of activities you're working on. We introduce you to the software in that call. So we'll provide you a login. The next step would be to enter the qualified activities in the software and just take a first pass and answering the questions, going through the 4-part test and documenting that. So after that's completed, our team of experts works through and reviews everything in the application on the financial and technical side. So folks like myself that have a deeper understanding of what the IRS is looking for and how things need to be presented, we go through it and we'll help you and leave comments and amend those answers if need be. And then after that process is complete, there are sometimes some base years that need to be completed in order to file the credit. But if not, we provide you with the forms that you need and provide you with the reports, and you're able to begin to claim that on your return and against your payroll tax. So the way it works on the payroll side, so let me talk a little bit about claiming it against your payroll tax. So when you do this, we take care of the large share of the process. So basically, when you claim it, the payroll tax is claimed on Form 941. And so we prepare the credit, deliver it to you, claim it on your return. On the form, it indicates you're going to use it against your payroll tax. And basically that just offsets the employer portion of Social Security tax on each payroll run going forward. So you're eligible to begin to use that the quarter after the quarter in which you file your return. So that's what you start to see it pretty quickly after that. And that's the portion it's used against, is that employer portion of Social Security tax. So I've talked a lot about our company and our platform, but just to sum that up, we're a technology-driven platform. It's a SaaS-based app, and we collect your company's data and what you're working on. It's self-guided. It's very time efficient compared to other processes, especially those I've worked with in the past. It's a relatively fun platform to work with and to use, and makes it easier from a transparency perspective. You can see what's going on. Our team, as we're working through it in real time, the credit updates in real time based on the financial information that's in the application. So everybody kind of is on the same page throughout the process. Our pricing is built to fit your business. We have a tiered pricing structure, so that helps. It's not a flat fee like some other providers have. So as your credit increases, the fee decreases. And our partnership, the way that we partner with our clients, we handle all the interactions with your CPA. Once that study is complete, we provide that to you. That lives in our system in perpetuity, just in case it would ever be evaluated by the IRS. We have all the documentation. We have the forms and the reports that were delivered. So we provide that to your CPA and payroll provider if you're claiming that on your payroll tax. And if there's inquiries by the IRS, our team helps with that as well. And then our platform is very secure, so it provides an easy place to log in, drop the documents in, and you don't really have to chase those later on. If there ever was an examination, everything kind of lives in one place, and it acts as the hub for your R&D. So those are really the four main points on why our platform is innovative, and I think it's there. I have not seen anything like this. I know there are other software providers in the market, but ours we designed from the ground up, and it's really designed around the client and thinking through what's the easiest way and most defensible way to mesh those together and provide that. So in the end of the process, our documentation includes a layout of the qualified activities. It lays out the qualified expenses and the qualified wages that are on the project. We provide the report that connects those expenses to the activities, and that's called Nexus. And the IRS requires Nexus in order to claim the credit. So that's what our whole software is built around, is creating Nexus between the expenses that you're putting in and what you're documenting. And then we also provide the credit calculation with that. So you'll receive all of those, and they stay with us as well, like I said, just in case. Perfect. So with that, I can take any questions that came in during the second half of that presentation. I went kind of quickly, but
no, this is great. They're already coming in. So let's revisit Chris's question about federal grants and SBIR. How do they qualify for that 4-step process, or do they at all?
Yeah, so with grants, unfortunately, grants, well, they sometimes qualify based on how they're written, and it's kind of a case-by-case basis. So we will examine that. If there's a lot of times what we've seen is if there are, we have to look at rights and the risk. So we want to make sure that who has the right to claim the credit. And so the funding has to be at risk by your company. So one way that happens is if you have a grant, if it's conditional, if you have to meet milestones or there's you know technical things or items that you have to meet in order to get funded or get that next part of that grant, and you're innovating, that's a way that the risk transfers back to the taxpayer. So there are ways that grants can qualify, but if it's kind of a non-conditional grant where you receive the funding and there's no milestones and you just get to keep that funding, we'll have to exclude that from the QREs or qualified research expenses.
Great. All right. Andrew Robinson says they were recently on a panel related to QSBS, which stands for Qualified Small Business Stock. That is usually stock in a startup that has some tax exemption status. In that panel, they were saying there's an upcoming change in the tax laws where software development would start to be categorized as a depreciable asset instead of an operating expense. Do you foresee that having any impacts in the R&D tax credits in the future?
Yeah, so that sounds similar to what happened to under 174 over the last year. So as you guys are probably aware, with the changes, so back from when the previous Tax Cuts and Jobs Act was passed, there were changes to 174 that many thought would go away here in this last, like right before the end of the year. They did not. So the R&D expenses under 174 have to be amortized over 5 years now. We see that it increases, the net result is it ends up increasing the tax liability for a lot of companies. And so with that, the credit becomes more valuable. The credit has not changed in the calculation method or the usability of the credit. So even though those items have to be amortized over 5 years, the R&D expenses have to be amortized over 5 years. You still, it increases your tax liability, but you're still able to calculate the credit the same and use it as a dollar for dollar reduction of your liability. So that's in relation to 174. But on the software side, I think it's relatively similar. The credit is calculated the same way. We can use the same methodology, and it's ultimately going to be, in my opinion, I think it'll be used the same way going forward. I don't think they're going to change that.
Awesome. James asks, the tax credit only applies to federal payroll, nothing state by state?
So there are, I forgot to mention in there are state incentives as well. So as a component of our app, when you log expenses and personnel, we have functionality where you add the states in, and when you add the states in, that helps our team. If you're in a state, I think there are 32 states now that follow the federal way that the credit is calculated. So there are a good amount of states that offer R&D incentives. So yeah, we help prepare those as well, federal and state.
Awesome. So this is a question about your guys' business model. What percent do you take from the tax credit that you find for your customers?
Yeah, so Hallie, I don't know if Haley's still there. She can touch on our pricing model, but it is a tiered pricing model. It varies on
how much of the
be
credit?
honest, I'm not. Yeah, it depends on the credit amount and the size of the credit. So I do know that when the credit goes up, your fee, it's a tiered structure, so the fee decreases. So that's how our pricing model is set up. If you have additional questions on that, we can definitely follow up.
There's Haley.
There's Haley.
I was just confirming. So it ranges somewhere between 10 and 20% of the credit. And then we discussed that once you have the completed credit amount and estimations. So
yeah.
That's the best way to know.
And you guys are like, you don't get paid unless they get paid kind of service, correct?
Yeah.
Correct. And that's a significant difference from the majority of the market. So the majority of the market is flat fee. We're able to work that way because we only work on the R&D tax credit. So we offer just services there. So that's how we're able to do that.
Thank you. Thanks for chiming in, Haley. William asks, prototyping. So a lot in startups is getting from A to B or from 0 to 1. You might not necessarily throw it away, so it's not long lived, but it proves a concept, and then you maybe rebuild a similar thing on a stronger foundation. Can that be considered into this?
Oh, absolutely. So prototyping is phenomenal. So the way that that's perfect. So it doesn't have to be so for supplies, when I say consumed or destroyed, that just means that they have to be used up in the process, whether it's saleable or not in the end, or whether you keep it or use it for further innovation. It's just the fact that you're using those for that purpose, and it's just ruling out the capital equipment rather. So yeah, prototyping is fantastic, and that qualifies under supplies for sure.
Great. Getting a couple more in here. Margie asks, if a company that supplies contractor is US based, so it's a US based company, but the contractors themselves are overseas, would that be eligible?
No, the people have to be in the US that are performing the work, unfortunately, but that's how that's written.
Makes sense. Jason asks, can legal fees associated with the patent applications be considered for R&D tax credits? So paying the lawyers
Yeah,
for patents.
absolutely. So those unfortunately cannot. They can be included under the deduction, but just not the credit. So the credit is more narrow than what qualifies under 174 for the deduction. So yeah, those unfortunately you can't claim.
All right. What about if you pay for an accelerator? So you have a pay for accelerator that helps you with your innovation, whether it's market validation or building some of your product, but you're not doing it in-house, but you're paying an accelerator for that.
Yeah, so as long as you're maintaining the IP in the end, and you don't have to have exclusive rights to the IP, but you have to have enough that you don't have to pay royalties on that going forward, and then on the you have to be funding that. So yes, we can include that.
Awesome. Does Clarus offer general bookkeeping or filing services in addition to the tax credit specific services?
No, so we only prepare R&D tax credits, and we have done some work in the ERTC space over the last couple of years. If you guys are familiar with the employee retention tax credit, but yeah, just those two areas, and we're winding down on the ERTC side.
All right. Yellow T asks, what are what and if are there penalties for claiming the tax benefit and then the IRS disagreeing that the work is actually R&D?
Yeah, absolutely. So that's a great question. So how that works is you're claiming the credit in real time. There's the statute of limitations to go back and review. So if they do that, they're basically making an adjustment to what we've calculated. Our clients traditionally, we've been very lucky, and I think our process has been very good. We've only had one audit throughout our time, and we've been in business since 2017, 2016, right after the PATH Act was passed, and we were able to get the first render of the software out and working. So to only have one audit is very good. And penalty wise, they would just come in. We would respond with why we feel that those expenses are qualified, and if they disagree, they would reduce your credit, and that amount would be due.
Great. Bridget Bell asks in the chat, can the credits be claimed if you're pre-revenue, or do you have to have kind of a product in market that's actually making money?
Yeah, so that is the whole concept of the payroll credit. So companies that are pre-revenue were never able to claim the credit in the past with the way that it was written. It was kind of for the big guys, and so that's what changed in 2015. So if you have employees that you're paying in the U.S. That are paid through W-2, or contractors that you're paying to do your work, and so yeah, we can claim that, and you claim it against your payroll tax.
Awesome. Back to kind of incubator accelerator stuff. Devin asks, participation in incubator in the US be counted as the credit. We did some research idea validation through this program and building our design prototype. I think from the previous question, if you paid for it, it was a paid for incubator, yes. But what about something like an incubator that might give you money for equity? Is there anything in there?
Probably not, because it would be unless there's some investment there. There has to be money spent in order to claim the credit on this fund. So,
but I guess if you got into an incubator and they gave you 100K and then you use that 100K to pay payroll to develop your idea, effectively that is qualified.
Yeah, as long as it's so that's where you get into third-party funding again, and grants. So there has to be some, if it's just unconditionally given and there's not really it's not their funding that's at risk, that we have to look at it on a case-by-case basis. But yeah, that's a good point. So if the risk was still on, in order to keep that money, if they had to meet milestones, or there was some at risk, or something that made it the risk transfer back to the taxpayer, then
yeah, I'd say where this 5 years ago, and the only model for an accelerator was money for equity, and if you succeed, they benefit. If you go out of business, so what? But there are so many accelerators and incubators out there now with so many different business models that it's definitely worth to get an expert to figure out if yours does qualify.
Yeah, absolutely. And we can go through the contracts. We have a very experienced team that can go through the contracts and pick out the clauses and
awesome.
Determine.
All right, we got one more here. Does rent at a wet lab incubator count as a qualifiable expense?
Yeah, so that's a good question as well. So we're not able to qualify rent. It does for the deduction again, but not for the credit. So for the credit, we're just looking at those three buckets. The supplies and the contract research.
Awesome. Well, we got through a ton of questions, kind of hit our mark here at the 40-minute moment. Haley, if you're still on the line, do you have some of the links that you wanted to drop? We'll send stuff out tomorrow with all these links, so it'll all be in one place. But for anybody that's sticking around, there we go.
So this button, I'm not sure if it'll work through the Zoom presentation, but when we send it out, you'll be able to schedule directly there. You can also reach out to myself. I think I can put my email into the chat real quick. And John, I have a question for you. We are quickly approaching tax season. So for everyone who is planning on filing in March or in April, can you talk through the deadlines and how much time we need to process those?
Yeah, absolutely. That's good to touch on as well. So yeah, deadlines are coming up pretty quickly. So if this is something you think applies to you, reach out to us. We usually, our turnaround time is much quicker than 3 weeks usually, but in order just to have some cushion on that, 21 days before your deadline is really when we need the final submission.
So quiet urgency of probably start getting at this because deadlines are coming up.
Yeah, and if you're going to extend, if you know you're going to extend, we can start the process now, and then just finish it by the time your extension deadline or whatever you want to file. So that gives some little bit of extra time, but yeah. So if you're planning to file in the upcoming 2 due dates, definitely reach out to us and we'll get it started as soon as possible.
Wonderful. Any other questions that might be helpful for the audience, Haley, or any things that we might have missed?
Nope, that was the last one I had.
Excellent. Well, thank you both so much for spending time with us this year and every year. It's great to see as many people here interested in those questions. We're spot on. It sounds like we have a good portion of our audience who might be in a position to take advantage of this. This is one of the, running a startup is figuring out how to succeed in between the lines, and every little bit helps. So, even if it's just a couple 10,000, could really be the difference between some runway and another meeting. So all the things that you can pull together, best of luck to everybody who's here. Reach out to the team if this looks appealing and you have some questions, even if it's a qualifiable expense. One of the best things are they narrowly focus on this thing, and they only make money if you actually have a credit to process. So it's really no real loss in actually just seeing what your activities are and if would they qualify. Thank you, Haley and John. If you have any last words, otherwise we'll wrap up.
Thank you, Ryan.
Perfect. Thank you very much. Appreciate it. Look forward to working with any of you guys that are qualifying.
Excellent. Well, have a great rest of your week, everybody. And if you're from Gust, be on the lookout. This is part of our this is adjacent to our launch curriculum, but we're doing a ton of programming for the next couple months, all around those early considerations of getting a company up and running. So keep an eye on your inbox. You'll probably get emails from me, a lot of emails from me. Please don't block me. But we have some great content coming up in the next week, and we can help fill this in. And please reach out to Claire's team, see if you qualify, and have a great weekend, everybody.
Thank you. Bye.